Tech Entrepreneurship. We are going to continue our discussions regarding valuation. When it comes to valuation, we need to begin at the end. When it comes to valuation, we oftentimes need to begin at the end, meaning that we're going to be talking a little bit about the exit strategy. The exit strategy. Now, Max, I know you're the only individual online right now. Can you give me an idea of what it is that I mean when I say we're talking about the exit strategy to determine the valuation? The exit strategy to determine the valuation. And Robert, feel free to chime in here also. Planning operations, that's a good start. And that was a good start given that I was asking you on the fly. How about what it is that you want to be when you grow up? What is it that you want to be when you build your business? How big do you want that business? Now, obviously, we always say, oh, we want it to be huge. Not necessarily. Not necessarily. Where in the blue ocean do you want to be? Or do you eventually want to cross over into the red ocean? You determine what you want your outcome to be so you know how to act to achieve it. That is very well said. Very well said. When you determine where it is that you want to be, so you have picked a point that you are going to march towards, you are now going to be able to plan tactically and a little more accurately how you're going to get there. And that is essentially what Maxwell has stated. That's essentially what Maxwell has stated. So let's talk a little bit more about your exit strategy. Let's talk about your exit strategy. It's important to recognize that before, again, this is like playing football. Before you take any steps forward, you're going to actually drop back a couple of steps and then go forward. Now, let's talk about what your exit strategy is. What is your exit strategy? Now, there are some, I'm going to narrow it down for us, okay? To be sold in less than 5 years. To be sold in more than 5 years. And harvest cash flow. To make acquisitions, grow the business, and sell in more than, say, 10 years. Now, these are three ideas. There is a fourth, and that is to eventually become publicly traded. To eventually become publicly traded. Now, the last one can be expensive and it can be a little bit difficult, but let's take a look at where we're at. You may have an idea, you may have a plan or project where you say, you know what, I'm going to open up this business, but I plan on selling it or licensing it out within 5 years. That's a very short-term mindset. And let me tell you, that puts a lot of pressure on you to perform a certain way. And that also means that you're going to have a lot of luck. Luck is a function of your work ethic. So either way, whether you plan on selling your business in 10 years or 5 years, you're going to have to be working a minimum of 12-hour days in order for this to succeed. That's just the way it's got to be. That's just the way it's got to be. But your expectations of your investors and your shareholders are going to be such that you're going to put on so much pressure that if it doesn't exactly work out the way that you had represented it to your investors within 5 years, you may be in a little bit of trouble. And by trouble meaning that you're going to have to go back to your investors and reevaluate your strategy. And a lot of people don't like to do that. If you tell me, hey, Aaron, I'm going to have your money for 5 years, okay, that's my expectation. Now, a lot can happen. I'm not going to be upset. I'm not going to be flipping out, but I am going to say, well, wow, you know what? I know we wanted this to happen a lot sooner, but the economy hit. Okay, well, we're still in business. That's the good news. I just think it's more prudent to have a 5 to 10 year outlook. That way you give yourself a little breathing room. And that's primarily with your investors. It's not to say that you're not going to be running scared and that you're going to be working your tail off every second of the day, but it does give you a little bit of breathing room. And it also tells me that you have a bigger and a greater vision. It scares me when I hear the quick buck turnaround model. Because the reality of it is that when I am investing in somebody or somebody's business, I'm investing into them. I'm investing into them. So the exit strategy to me has all to do with you. I'm investing into you. I want to make sure that you've got your bases covered and that you've given yourself enough of a ramp, enough of a runway that you can actually take off. You can get this bird off the ground. Number 2, sold greater than 5 years and harvest the cash flow. Maxwell, what do I mean by harvesting the cash flow? When I say that you have an exit strategy of in excess of 5 years and harvest the cash flow, what is it that I'm actually meaning? Building working capital, okay, you're actually right on the right track. Harvesting cash flow means that you're going to be getting a dividend. You're going to be getting a distribution in the form of a dividend. So, you plan on harvesting that cash flow. So you have built a war chest of working capital up here. But it only takes this much to operate the business. The delta from here to here is the cash flow that you're going to harvest in the form of a dividend, meaning that you're going to actually take that and put it into the investor's pocket, pro rata their percentage interest in the business. Do you understand that? Does that make sense? Am I crystal? Excellent. Thank you, Maxwell. The way businesses make money that have been in business for 20 years is they harvest the cash flow out of their working capital because they understand that it only takes a certain amount to operate this business every month. Anything above and beyond that is gravy. And that gravy comes to you in the form of a distribution. It comes to you in the form of a dividend. A distribution could be And I've seen this with companies like Kellogg's will send their investors a distribution, but it's a box of cereal. It's not cash, it's a distribution of something that has value, and it's cereal. In this case, we're talking specifically about money, so you're going to get a distribution in the form of cash. Again, pro rata your percentage equity in the company. So if there are 10 investors and each investor has 10%, that's 100% of the pie. Each investor, and it's $100,000, each investor is going to get $10,000, right? And it only takes $30,000 to run the business, and there are $130,000 in the coffers, so there you go to your $100,000. Now, you may have a little more aggressive strategy where it is that you want to build this business and build it for 5, 10, 15 years. And in order to do that, you're not just going to build the business organically. It means you're not going to just build it internally and build your infrastructure. You're going to actually buy competitors, or you're going to buy other companies that are in your business. So you may be looking at a vertical or horizontal acquisition. So along with number 3, acquisitions, there are 2 types. There's vertical and there's horizontal. Okay, now a horizontal acquisition is a direct competitor. They have the same model as you. Let's say that you're a pizza place and you decide that you're going to buy another pizza place. I mean, it's a horizontal merger. You're like companies and you're just expanding your footprint maybe into a new geographic area, or you're expanding your brand into a new area. Or let's say it's in the same area and you're just locking down the market. Okay, so horizontal merger is a competitor. Am I clear on that? Now, a vertical merger is going to be one where, let's just say that you're tired of paying for flour. And you're a pizza company and you're tired of paying all of this money for the cost of flour. You want to control that. So you go out and you buy a supplier in, we'll call it the supply chain of your business. So you are actually buying, so it's like a diamond company that is buying the actual mine. They're not just a retail outlet, but they're mining it, they're refining it, and then they're retailing it. Okay, so they're not just buying another diamond competitor. That would be a horizontal merger. They're doing a vertical merger. Now, when you do an acquisition, when you're doing an acquisition, you're expecting to grow the business. And you're going to accelerate that growth through the acquisition. So you should be getting much bigger, much quicker than if you did it organically. There's a lot of risk there because you're talking about leverage, you're talking about borrowing money, raising additional funds, possibly through additional investors, through equity. Could be borrowing or it could be equity, but either way, you're going to need more money to make an acquisition. And the last is to be publicly traded, where your exit strategy is such that you decide that you're going to be liquidating a lot of your equity under the public markets. You're going to do an initial public offering, your company is going to become publicly traded, and the market will determine the value of your business. You will be able to sell your business shares, your equity, on the open market. And you want to be publicly traded because valuations of publicly traded companies are often much higher than privately held companies. Why are publicly traded companies oftentimes valued higher than privately held companies? It's a fair question. The answer is because there's an element of liquidity that you don't have and brand equity that you might not get as a publicly traded company that you don't have as a privately held company. So essentially, a privately held company doesn't have that liquidity, and liquidity is a big deal. Being able to sell your shares in a second or buy shares in a second without the rigmarole of dealing with lack of, let's say, a lack of a market for it. That's a big deal. I mean, if you're a privately held company, you want to sell your shares, heck, you might have to go find that investor yourself. Heck, you might have to, you might have to get current founders to try to buy your stock. Nothing happens easy, nothing happens quickly. As a publicly traded company, it might happen in a split second. Either way, your exit strategy, one of these fours, is what you want to be when you grow up. What do you need? What do you need in order to grow? What do you need in order to grow up? We're going to talk about deal drivers. I'm going to talk about some deal drivers in terms of, for an entrepreneur, what it is that you need in order to grow up so you can effectively create one of those four scenarios that I just went over. So you're going to need resources. And the resources are going to come in the form of people, capital, and external expertise. As well as internal expertise. You're going to need both internal and external expertise. Now, what do I mean by external expertise? I'm talking about an advisory board that has no liability and very little equity, if any, in your business, that are willing to provide a certain level of professional expertise to allow your business or to help you grow your business. These resources are critical deal drivers to grow the business to effectively execute one of those four exit strategies. How do you obtain these? How do you obtain? First of all, I want to make the point clear that you need to understand that in order to get your business off the ground, these deal drivers are things that investors look for in companies. They look for the right management. They look to see that the capital they're going to give you is going to take you to the next level and beyond, and that there's a certain level of expertise that you have and experience in the business that you can source internally and externally to grow that business. How do you obtain these as a startup with little or no capital? How do you do this? You have to get buy-in. This is where your story comes in. You have to get buy-in from your potential investors, from your potential lenders. Again, I'm not big on a startup or an individual borrowing money to build their business, but I am much more keen on you acquiring funds, and in return, you're going to give what? You're going to give shares. And Maxwell, you're absolutely right. You're looking at obtaining buy-in from the cult, and you're looking at obtaining some expertise from the cult. The external expertise that you're going to get is oftentimes going to come from the cult, because they understand and they have a different perspective also on the market, but they understand the market and your target market and constituents often better than you do. Better than you do. So let's pause it here. Let's pause it here. Here's the corpus. You need money. To create. You also need buying. But you need money to create the venture. And investors need a return on the cash they have at risk with you. This is the trade-off. You need money, they need a return. They're taking risk. How do you do it? How do you get that money in return? What percentage are you going to be giving them? What kind of return are you going to give them? What kind of return are you going to give them? And here's the thing. This is often exactly how it goes down. People say, you know, if I'm going to invest, I need a certain return. That's when you're loaning money. That's when you're getting money and you're borrowing. When you're getting money from investors that are going to have equity, it's different. I don't want you to talk about a return. I don't want you to talk about a percentage of saying, hey, I'm going to be able to sell this, or we're going to make 100% on our money, or 500% on our money. That is the fool's gold of it all. Don't put yourself in a position where you are talking about giving them a 500% return or 200% return in 5 years or 2 years. Here's what I want you to do. Now, if you're borrowing money, you're going to have to tell, there are 3 things to a loan. Collateral, interest, and time, right? Collateral, interest, and time. So the interest is the return. So in a year, okay, I promise, my cousin Chewy that I'll give him back a 20% return if he gives me $10,000. Okay, well that's fair enough. But a lot of times investors that are looking to get a piece of equity in the company, they say, well, I need at least a 20 to 40% return on my money that's at risk every year. And you're going to say, yeah, I think this can do even better than that. Well, don't get caught into that fool's gold trick. Here's what I want you to show. The entrepreneur is going to raise money, and you're going to raise money effectively by showing that management can make 1 plus 1 equals 3. Not 4, I'm sorry, not 2, but 3, or 4, or 5. You need to be able to show your investors that 1 plus 1 is 3. What do I mean by that? What do I mean by that? And what do I mean by management? Why did I bring management into this thing? What do I mean by you're going to raise money and you're not going to talk about a return? What you're going to talk about is, look, if I have a little bit of fuel, if I have a little bit of gasoline, I can stretch that and I can make that into, instead of 1 gallon taking me 10 miles, that 1 gallon of gas is going to take us 100 miles. We're cooking with gas. If I have a little bit of fuel to throw in the fire, it becomes an inferno. One plus 1 is 3, because I'm here to tell you that 1 plus 1 equals 2. That's a status quo. You need to be able to show, it's like this. Let's say I'm digging a hole. Maxwell and I are digging a hole. We're planting a tree. And it's going to take me by myself. Maxwell isn't involved yet. It's going to take me an hour to dig that hole by myself. A 3-foot hole by 3 foot. We're planting a Japanese plum. I'm sorry, a Japanese maple. One of my favorite trees. Well, it takes me an hour, and then Maxwell comes by and he says, "Hey, you know, you haven't started digging this hole yet, Aaron. You know, maybe I can help out." And I'm going to say, "Wow, Maxwell, thank you very much. I really appreciate that. I would love for you to help out." So we start digging this hole. Is it going to take us a half an hour to dig that hole? The two of us together? No. It should take us about 20 minutes. Whereas it took me an hour by myself, 2 people, it's going to take about 20 minutes. This is where 1 plus 1 equals 3. This is where the whole is greater than the sum of its parts. Okay? Where 1 plus 1 equals 3, or 5, or 6, or 10. This is where Facebook was able to show, hey, look, you give me a little bit of money, and I'm not gonna turn that $1 into $10 in revenue. I'm gonna turn that $1 into $1 million in revenue. You see the point, you see the difference. And I'm not talking about giving a return to the investor, I'm talking about revenue. I'm talking about my management team being able to execute to a point where $1 creates $1 million in revenue for us. That a little bit of your money will go a long way. It's going to be 1 plus 1 equals 10. And now in Facebook's case, it might have been 100. Imagine you would put $10,000 into Facebook in 1993. What would that be worth today? You'd probably be talking about several $1 million. But he never talked about a return on investment to the investors. He talked about what that would actually create in terms of value. It's up to you to then determine whether or not, as the investor, that's going to be worth your risk on capital. That's going to be up to the investor to determine whether or not that is worth it. It's beyond 1 plus 1 equals 2. And these points should be covered in an elevator pitch, because that's exactly where investors are going to make up their mind whether they're going to invest in you or not is and here's the thing. I bring up management, that's a great point to segue into Max. Why I bring up management because investors are investing into people, not models. Not models. I'm here to tell you that every model I have ever seen, every business model that has ever been presented for me to invest works. Every single model I have ever seen works. That's right. Who's going to present a model that doesn't work to an investor? No one's going to present a model that doesn't work. Where the rubber hits the road is when I see that model and I say to myself, can Maxwell execute that model? Does he have the expertise? Does he have the internal and external expertise? Does he have the management capability to execute that model? That's the question I need to ask myself, and that's where I need to hear it from Maxwell in his elevator pitch, whether or not he can show me that he can execute 1 + 1 = 3, because every model I've ever seen is 1 + 1 = 3. Can Maxwell actually do it? Can Maxwell actually do it? I think that's paramount. I can't tell you how important it is. Now, you also need to be able, there is a saying, I don't fully subscribe to it, but I have to tell it to you. I don't fully subscribe to this, but I have to tell it to you. The person or the management team that is able to articulate the pain the best. Let me repeat that. The management team that is able to articulate the pain of the marketplace the best gets funded. If you can tell the investors in your elevator pitch what the pain is, better than the competitors, there's a high probability you're going to get funded. But what if there is no pain in the marketplace? What is the gap? There is no pain. Let's take a look at my gnomes. Let's take a look at the gnomes that I created. Was there a pain in the marketplace for people needing gnomes in culture? Was there a pain where people were saying, oh, we need something else? No. Gnomes were selling along and are selling along just fine in the marketplace. There's no pain. I just created an additional market for gnomes. And people liked it. So I wasn't able to articulate a pain. But I wasn't able to articulate a gap in the marketplace, but there was no pain. There was a gap, but no pain. Did I get funded? Did people buy the product? Did people want the product? Absolutely. No question about it. 100%. Absolutely. Tell the pain better than your competitors. But I qualify that in the sense that oftentimes some of your projects, some of your entrepreneurial ideas don't have a pain, like mine didn't have a pain. there was a clear gap in the marketplace. Strangely enough, after a couple of beers, I came up with a gap that actually, I created an entire sector. I never thought that I would create a sector of cultural gnomes. Before I came along, and before that beer came along, I should say, there was no such thing as gnomes in culture. But there was no pain. And a lot of people would have said, nah, you know what? I don't see it, Aaron. I don't see it. I don't see the pain. I don't know why people would buy it. There's not any real anguish out there in the marketplace. You're not doing anything that really solves a problem. In fact, my gnome is the most unfunctional piece of hardware you could possibly buy. But it makes people smile. So, when I say it tells the pain better than anyone else, yeah, but if there is no pain, you need to be able to articulate. You need to be able to articulate the gain. Okay? It's kind of like Steve Jobs, and I'm not comparing myself to Steve Jobs by any means, but he had decided early on when he was building the computers that, you know what? Let's put fonts. Let's put numerous different types of fonts. Gothic, Euro style, New Times Roman, et cetera, into our operating system. There was no pain, but it made people smile. Okay? A very clear articulation of the pain in the marketplace will take you a long way. All right? Now, we have a lot to talk about with respect to valuation and exit strategy. I'm going to end it here today. I'm going to cut it short by about 10 minutes. And you're going to think about, for the discussion board this week, what the pain is in the marketplace for a possible idea that you have, or a pain in the marketplace that somebody else came up with that they are filling. Do some research. What is the pain that was filled when maybe Apple got into the marketplace, or Intel, or any company you can think of? What is the pain? So on the discussion board, I want you to talk about the pain or the gains that you have seen in the marketplace. Summarize it. That's going to be your homework for the discussion board for this week. Now, without any further ado, have a great weekend. We're going to be here at 1 o'clock, same time, same channel on Tuesday. I'll see you then. Have a safe weekend. Over and out.